Good afternoon, friends. Happy to be doing this call at the end of quarter three. Let me first start with a little bit of the big picture situation. As I have mentioned publicly, I am seeing an improving micro, but a more challenging macro. And this improving micro is now manifesting itself in clearly a better loan growth situation, which we have been seeing on the ground. And as you would notice, we have reported a 23% loan growth on both consolidated and standalone basis YOY. And we, at this stage, believe that the momentum of a 20% plus loan growth seems to be sustainable. Moving on to some specifics, our engine on customer acquisition continues to grow pretty strongly. We have crossed 12 million customers, as some of you may recollect, on 29th March, when we launched our 811 digital bank account. We had mentioned that we are at about 8 million customers then, and we had indicated that within a period of 18 months, which is by September 18, we would be double the number, which is at about 16 million plus customers. And our current path gives us conviction that we are well on our way to our customer journey and growth. Overall, in terms of the credit cycle, the new flow into challenging accounts has slowed down for us, and we therefore are essentially on the path to making sure that we are resolving, recovering, and correcting the existing stock. And the new flow seems to have slowed down compared to the earlier, except maybe in some pockets, but in general, the flow of problematic credit, at least in our books, seems to be much under control. As you would go through our numbers, while our bank has had a pretty steady growth in this quarter, despite more challenging bond markets and everything else, we have seen a significant growth coming into our subsidiaries, particularly the four areas which are having an excellent time in the marketplace, namely the securities business, the investment banking business, the asset management, and our life insurance business. And if you sort of dissect our numbers, which my colleague Jamin will also take you through, if you take out our banking and NBFC businesses and look at these four businesses broadly, the actual growth rate in profits YOY is nearly 80% on those numbers. So while on a consolidated basis, we have grown at 28%, the bank itself at around 20%, these businesses, namely securities, investment banking, asset management, and insurance, have recorded a growth of close to 80%. And keep in mind, by design, the bank owns 100% of these businesses. As I look at it, the key question is the whole situation, both on a macro and a micro position from here in 2018. Our view is micro trends continue to be strong. The formalization of financial savings and digitization of the financial sector continues at a brisk pace. Our view is for well-focused lending, the credit cycle is certainly feeling better at this stage in the overall context of things. And all these investment products at this stage seem to continue to rally as the capital markets continue to rally pretty briskly. And it's back to the point that not only are global flows looking pretty good in January, they're combined by a significant amount of domestic flows which currently don't show any signs of significantly receding. So in this background, the financial sector, at least at this point of time, looks like in a sweet spot. But as we always know, that we need to keep our alert on some of the areas, particularly in the capital markets, where money flows are just driving behavior, particularly as I've mentioned in my media interactions, the small and mid cap space, which is seeing disproportionate flows as well. But on the big picture, financial services industry is in certainly for pretty good times. And with that, I will now hand over to my colleague, Jaimin Bhatt.
Thanks, Uday. Let me just take you through the earnings update, which is with you all. This quarter, at the consolidated entity level, we end with the profit post-tax of 1624 crores, 28% growth from the same period last year. And we've seen contributions coming in from a variety of entities. The bank contributed 1,053 crores, and as Uday was just briefing you, the whole area of securities, investment bank, life insurance, and others have contributed. The securities company, Kotak Securities, clocking 154 crores profit post-tax for the quarter, which is its best ever in the history. Prime contributing 148 crores. The insurance company just below 100 crores. The mutual fund, the investment bank, as well as the international companies, again clocking substantially higher numbers than what they had done in the previous year. And as Uday spoke about, the contribution of the non-bank and the non-NBFC entities, which grew 80% from last year, now that portfolio constitutes about 23% of our post-tax profit for this quarter, which the same period last year was about 16.5%. So we've seen a big growth coming in from the subsidiaries during this period. At the consolidated level, the loans at 1,95,000 crores. Net interest margin at that level, at the consolidated level, again at 4.2. Healthy tier 1, 17.9%. During this period, we also completed the acquisition of the Old Mutual stake in our life insurance joint venture. So now we own 100% of the life insurance entity. The growth of advances at the consolidated level being 24% on a YOY basis, and the net NPA at that level at 0.94%. We have a net worth now across the group of 48,000 crores, ending up with a book value of 255 rupees per share. At the standalone bank, this quarter recorded a profit of 1,053 crores, 20% rise over the same period last year. Net interest margin at the bank at 4.2%. The net NPAs have dropped to 1.09% this time around compared to 1.26 a quarter ago. In fact, if I look at the gross NPA for this quarter is lower than what we had in the immediately preceding quarter. So we've had a negative growth where effectively the slippages during this quarter are lesser than what we've seen recoveries and upgrades. Tier 1 in the bank at 18% and CASA at 46.7% overall. If I look at the P&L, the NII, we've seen a growth of 17% during this period. The other income has clocked 1,040 crores during this quarter, with fees and services bringing in 829 crores, and other than fees contributing 211, helped to some extent by recovery on our stressed assets. Our costs for this period include the fact that we've continued to spend on 811, and that's been into the current quarter. So pre-tax profit of 1607, pre-tax profit of 1607 with post-tax 1053 at the bank level. The SMA2 numbers continue to be low. We are at 0.19% of our advances, and restructured standard again at 0.04% of our advances. Among the segments, the corporate book contributing 784 crores out of the 1,600 crores of pre-tax profit. Advances growth at the bank has been at 23%, and we've seen growth across the segments. The CVC is showing a 37% growth. Small businesses, personal loans, credit cards, again showing a sharp growth, 45% on a year-on-year basis. We've seen growth across agri, the corporate bank, and across the sectors which we operate in. On the liability side, 46.7% CASA. If I look at average numbers during the period, which is during the quarter, on a daily average basis, we've seen current account show a rise of 21% over the previous period, and savings account at 60% higher than the same period last year. Our CASA plus term deposits of less than 5 crores, constituting 75% of our total deposit base, and the total cost of SA at 5.5%. Our overall balance sheet at the bank level just short of 2.5 lakh crores now. Shanti to run through the digital slides before I come back to the subsidiaries.
Thank you, Jaymin. We continue to focus on bringing best-in-class experience for our customers on the digital side. Some new introductions this quarter. We introduced facial under biometric authentication in the mobile banking app, both facial as well as fingerprint. Again, we have a new Forex platform where through Aadhaar OTP you can have instant online remittances, and for online shopping below 2,000 without OTP, which has seen a significant increase in transactions. Across our products, we continue to see incrementally, 83% of our recurring deposits, 65% of our fixed deposit, and 32% of our personal loans being sourced through the digital channels, and this continues across our assets and liabilities. As far as payments is concerned, digital is a way of life, and we've seen continue to see the growth on mobile, payment gateway, UPI, where we've seen a 7x, on a quarter-on-quarter basis, our M-Store. And in terms of our ranking, the ministry gives targets for each bank on digital transactions, and we are amongst the top 3 banks in the country as per their ranking itself. 811, Uday talked about the fact that we are more than 12 million customers of the bank, and to others, I'm on 811, total customers of about 12 million plus of the bank. And in terms of the metrics of 811, 45% of 811 customers are salaried, 91% now comprise between 80 and 40 years of age, 63% of customers are from the top 20 cities. We had 2 new innovations. One, of course, the entire welcome kit has become digital. More importantly, now customers of 811 can apply for credit card and get them on the go on 811. Not just the bank, but the subsidiaries focus continues to be on digital. Kotak Securities particularly saw a surge in volumes on trading through mobile, and that is because of a number of new initiatives that they had launched. Kotak Life Insurance, 78% of the individual policies continue to be through digital, that is the tab, and Kotak General Insurance, 30% of the new business that is sourced comes through digital means. So digital continues to be a focus and a way of life at Kotak. Jaymin, over to you.
Sure. Let me talk about the subsidiaries. Kotak Prime, which is primarily into cars, 70% of the book constitutes the car finance activity. We ended this quarter with a post-tax profit of 148 crores. Again, showing low net NPAs at 0.4% and a healthy capital adequacy at 16.6% as of September. The Kotak Mahindra Investments, which is largely lending in the capital market and commercial real estate space, saw a 28% growth on its asset base and ending with 7,700 crores. NII of 77 crores, and we ended with a post-tax profit of 50 crores for the quarter. Net NPAs here at just 0.05% with cap add of 16.8 as of September. Kotak Securities, as I mentioned, on the back of record volumes and market share, we've got the best ever quarter and had a post-tax profit at 154 crores for the quarter. We've seen growth both on the retail side and the institutional side there. The life insurance company clocking new business premium of 831 crores, which is about 38% higher than last year. The investment performances of the funds continuing to be at the top quartile. The conservation ratio at 87%, high solvency at 3.08%. And I think the investment bank, again, a very active quarter. We've been involved with a number of IPOs, QIPs, offer for sales, as well as the advisory side. We clocked a post-tax profit of 36 crores for the quarter, and the revenue at 76 crores after sharing with the securities company on the distribution for IPOs and QIPs. Our overall assets under management grew by 37% on a year-on-year basis. We end the period with 1,82,000 crores. We've seen a big rise in our domestic mutual fund, where the overall equity base has doubled during the period from 22,000 crores as of December 16 to close to 47,000 crores as of December 17. Even the debt fund has grown significantly. Our offshore fund going almost a 50% growth from close to 22,000 to 32,000. Our asset management company ending the period with a quarter profit of 38 crores. Those broadly are the highlights during the quarter. We'll be open to taking questions.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. We request all participants to limit their questions to 2 per participant. Time permitting, you may come back in the queue for a follow-up. We will take the first question from the line of Ashish Sharma from Enam Asset Management.
Good evening, sir. Thanks for the opportunity. Just 2 questions from my side. One is on outlook on the net interest margin. We've seen, I think this is for the system, I think given that yields are under pressure, the revenue growth is not in sync with the loan growth. You mentioned that you see a pickup in credit cycle, but will that credit cycle be matched by a NIM which will not be, which is under pressure at this moment for the system and for Kotak Mahindra Bank? That is one. And second would be an outlook on the CASA. We've seen a big boost for CASA for the system and for Kotak Mahindra Bank. So as the impact of demon-led improvement wanes, do we see the CASA ratio to be at these levels? These are the 2 questions.
Okay, I'll answer the first question first and then come to your first question. As you know, on the CASA journey, we are amongst the few banks which have held out the 6% number for savings account deposits. That annually costs us in a PNL based on our current savings base more than 1,000 crores a year on PBT basis, which is what we currently absorb. That is continuing to give us significant wind on our savings accounts growth. And we therefore see the CASA journey continuing to be pretty robust and strong even from here. And therefore, on the a steady increase in our CASA, including the fact that the 6% is working to our advantage for a faster delta growth compared to the industry, is something which we see as continuing from here. And we are happy to see that number grow at a very fast clip going forward. On the matter of NIMs, I think there are 2 or 3 things which we need to keep in mind. One is between April to December, for almost the entire period, you were in a situation with surplus significant liquidity. A lot of domestic surplus liquidity was flowing into mutual funds, both liquid, short-term and debt, as also surplus liquidity lying with banks. And that has led to a competitive pressure on the lending rates, which is what you've seen manifest itself for actions over the last 3 to 4 quarters post-demon and continuing pressure on margins. However, the liquidity situation is not as flush as it was for the first three quarters of this year. And whenever liquidity gets a little tighter, and I'm not saying that it is in any panic situation, but as liquidity gets tighter, which is what we are beginning to see, wholesale funding begins to dry up. And that is where the core franchise on the liability side starts playing its role. And when that happens, you begin to see the pressure on margins actually start reducing. And we therefore see this change in situation where on the asset side, as a bank, we were competing heavily, of course, with surplus liquidity banks, but also with wholesale funded institutions who were able to compete and bring down the rates for the last 1 year. We see that actually as bottoming out, and therefore we are not dramatically concerned about significant drop in NIMs from here. The second important point, which is something which I think the system needs to be aware of, and which is a pressure on net interest margins, is the whole LCR regime, or the liquidity coverage ratio regime. And I think we need to keep in mind that from January 1, this liquidity coverage ratio has moved to 90%. So banks had to start preparing in the second half of the third quarter towards keeping buffers for a higher LCR ratio effective January 1 on a daily basis. And if you look at the math today, unless currently on a 19.5% SLR, the RBI allows a fall SLR, that means amount of SLR which is adjustable to LCR, as 11%, which means 8.5% of NDTL as SLR plus 4% of CRR is not allowed as adjustable towards LCR. And assuming LCR went from 90% to 100%, out of this 12.5% surplus CRR plus SLR, what is needed for reaching 100% is around 2 to 3% only, which means at the current level, and we all know SLR stands for statutory liquidity ratio and CRR is for cash reserve ratio. At the current level of liquidity requirements by the regulator on banks, we are, as an Indian bank, maintaining LCR significantly higher than the 100% global benchmark. And this surplus liquidity which banks are currently required to maintain actually has a cost in terms of the margins. And I do hope and believe that the RBI in due course will reduce or allow more drawdown into the SLR to reduce the burden on banks of this excess liquidity which they have to carry in liquid assets at much lower margins. And I think the analyst community and investors need to keep this in mind as it is beginning to have an impact across the banking industry. So having said that, on the pure marketplace, we are less worried about dramatic drop in NIMs from here. And on the LCR side, that is a cost and a burden, which is now in the hands of the regulator to moderate as we go into 2018 for the rest of the year. So I hope that answers broadly your question.
Thank you. We will take the next question from the line of Kunal Shah from Edelweiss. Please go ahead.
Yeah, congratulations, great set of numbers. So mainly on the non-banking side of business, so obviously the capital market activities have been robust and we have gained out of it. But looking at the platform which we have created, invested into digitization as well as the customer acquisition, how much do we think is on account of leveraging our own platform, and how do we rate ourselves in terms of either cross-selling and creating the synergies out of each and every businesses which is there within the group?
Kunal, I think it's a very good question. We can always do better. I think the ability to cross-sell in a manner which is customer-centric is something which I think we are still in very early stage of the journey, particularly on the asset side of the balance sheet. And we are focused on getting that digitally driven cross-functional leverage as we go into the future. And I will ask my colleague Shanti about how she sees the potential for cross-sell in the digital world, where I do believe that we made good progress on the liability side. We need more progress on the asset side going from here.
Thank you, Uday. I think there are two parts to it. Because we also got the benefit of an added network this year, we saw cross-sell go up significantly because we had an opportunity in the entire network. So on the asset side, we did manage to get the uptick on the ING network that we acquired, which was relatively undersold too. So we got a big, we saw an uptick from there. I think there is a tremendous opportunity even on the liabilities and the asset side. We continue in our journey. I think we keep putting milestones and reaching there, but there is still a big opportunity and we continue to work on that front, both on assets and transactions and the liability side.
And even if you look at outside of the bank, maybe in terms of be it the securities business or say the asset management, how do we try to leverage the various online platforms which are there and maybe get the maximum wallet share and make the customers much more sticky and leverage on that front?
Yeah.
No, I think if I say life insurance, general insurance, and asset management, I think 50% plus of volume for life and general comes out of Kotak Bank distribution. For AMC, we have a real open architecture, so our overall bank's distribution of asset management product, the share of Kotak AMC is just about 20%. So I think in terms of opportunity, if you are seeing opportunity in terms of leveraging outside platform, I think if we have 20 plus from bank for asset management, for example, the rest is all done by the other banks and national distributors and IFAs.
Thank you.
Security. How much of security?
No, securities.
For securities, the bank is an important channel for acquiring clients. The bank will be contributing about 40% of our total fresh customer acquisition. And we work very closely with the bank for seeing that we also share the customers which they acquire for us are also the customers to whom they sell other cross-sell products like mutual funds, etc. So that way we are able to get a good wallet share of the customer.
Thank you. We will take the next question from the line of Amey Sathe from Tata Mutual Fund. Please go ahead.
Hello, sir. Congratulations on great numbers. Two questions from my side. First is that in the various press reports we have been talking about participating in some of the NCLT cases. So as a Kotak Group, if you can help us understand what are the opportunities that we have in such participation in such distressed cases. And second question is on their SME lending side. Have we seen any increase in turnover for some of your SME borrowers post GST implementation?
I'll ask Deepak Gupta to answer the first question and maybe what was your second question?
Have you seen is your SME clients are experiencing any increase in turnover post GST implementation?
Yeah, I'll try and take the second. Deepak, why don't you answer both? Chalo.
I think the first one is easy, like we've mentioned in the past. We intend playing this basically across the three broad propositions which we have. A is out of the bank itself. B is out of assets which we pool together and manage consolidatedly. And C really is through the ARC. If you look at the scenario today, yes, a lot of transactions have been progressing. We are watching each of these closely. We are trying to participate selectively in transactions where we think we can make a difference and there is economic sense in participating in that. But more importantly, I think it is very important in the beginning to watch the space. A lot of moving pieces there in this space at this point of time, including the legalities really. Yeah. So I think we will watch the first few set of transactions, participate to the extent required to maybe wet our feet, and then probably plunge headlong once we are very comfortable with the space around. I think it's a very long tail business. We're talking of a very large base of assets, all of which will probably be available over the next 6 to 12 months really. So we are patiently going ahead with that really. On the second one, SME, I don't think we've seen any significant growth in either the turnover or the working capital requirement on the SME side. In fact, what we've seen really is in some of the SMEs, we see maybe worry that the GST system is still not supporting them and they're not able to participate in the full chain really. So the SME piece at this point of time does not look like a growth opportunity from the GST perspective really. I think a lot of them are still trying to, find ways and means of, seeing how between the gross payable and the input tax credit, they can make their margins.
Thank you. We will take the next question from the line of Agastya Dave from CAO Capital. Please go ahead.
Thank you for the opportunity, sir. So you mentioned what was happening in the bond markets and the spike that we have seen. I wanted your thoughts on the macro a little bit more. So on one side, we are seeing credit demand picking up. On the other side, we are seeing yields going up. So I was just trying to understand, is it just the macro which is driving the yields up, or on a broader scale, will we see this yield, the spike which is happening continuing to, let's say, 8%? I mean, what's your sense there, sir?
Yeah. Look at 2014 to 17. It was a period where we had consistently improving macro. Whether it's oil prices, which reflected in our current account, our fisc was improving, inflation was coming under control. The macro story in India for 3 years, 2014 to 2017, was one with significant tailwinds. And in many ways, some of our tougher reform, including DeMon and of course the early part of GST, had happened in a time when macro was very, very comfortable. Therefore, I think macro actually saved us from a lot more pain which we would have had if we had a tough macro for the first 3 years. So in this period, our micro did not grow as fast as we would have liked, despite a good macro. And private investment was in a very slow cycle, partly hurt by the whole bank NPL situation and this postponement of reality by banks and borrowers for many, many years, starting sometime around 2010-11, really created a situation where new micro growth was getting stunted. Now, the situation is with, I think, global interest rates steadily inching up, and one can debate the pace. Equity markets at this point of time believe that the pace will be more sort of moderate and not dramatic. And on the global basis, and with a weakening dollar, you're seeing significant money flow all over the world, and also the US getting the big steroid of lower tax rate and everything else. So a steadily rising yield is a reality over the next 12 to 24 months. Now we can debate where oil will be. India is disproportionately sensitive to oil in terms of our import basket, whether it is 60, 70, 75, we don't know where it stops, but the current base case of most people is oil in the 60 to 70 range. But who knows where it goes, because oil has been one of the most unpredictable commodities which we have seen from time to time. Therefore, moment you have these factors, the third factor is that because of these investment flows, and a weaker dollar, you have a very strong rupee, which is putting pressure on our exports. So, in this situation, on the macro side, after 3 years of good macro, you will have challenges to a gradually increasing global interest rate scenario. Though the global markets are clearly on a roll with huge monies going into equities, but a significantly tighter interest rate cycle as we go into the future. India's current account deficit, now people are talking about 2% plus as we go from here. And in a bull market, people start ignoring a gradually developing or a warming of water while it happens. In the early stages, as you know, from cold water, when you go to warm water, actually you feel better. So,
Yeah.
till it begins to get too hot. So, we are right now in a situation where the water is warm, it is not too hot. So, after 3 years of cold micro water, it's feeling good because markets are on a roll. But the water is warming up steadily. And then, of course, on the fisc, my personal view is the government will be able to manage the fisc in a reasonable number, but will be having the ability of dipping into a lot of monies from the PSUs the government controls. Now, therefore, on a purist basis, these are not technically part of the fisc, but money from PSUs belonging to the government will be used to keep fisc under reasonable check. So that is my view on the macro. Now, how it translates to earnings, equity, performance, I think is something we got to watch. So this is a warm water cycle right now.
So, sir, just a small follow-up. What's the boiling point then? And my second question is, my second question is that you have been very, very clear over the last couple of months, I think, that you are not very comfortable with small caps and mid caps. Are you seeing similar problems on the retail asset side? Because the growth there has been blistering. Almost everyone is entering some of the spaces which are attracting a lot of competition as well as growth. So are you similarly worried on the retail asset side? Are we going to see a bad cycle there also anytime soon? And the follow-up to the commentary that you just gave, what's the boiling point according to you?
I wish I knew the timing of the boiling point. So we have to watch the situation. Let me tell you one thing. If 1 month down the line oil is back to 60, your boiling point gets, you may not see a boiling point and you may be in a wonderful warm sea for a long period of time. But it's a fast changing movie. So at this point of time, interval, whether I can't say whether we are at the interval, after the interval, but it doesn't feel like we are before the interval.
And assets.
And on the asset side, I think the good news, and I think we have to be clear, the good news is even now, the Indian consumer, as we talk, is not over leveraged. Okay, so fundamental leverage of the Indian consumer is still not at levels where we need to worry. But as I see it, what will happen is that as funding rates go up a bit, wholesale funded borrowers, wholesale funded financiers will start taking more and more risk to make their margins. So you will see that gradually move forward. And I'm not a betting man, but I don't think the problem of retail stress is a problem of 2018. Could be a problem of 2020, 21, maybe, but not certainly of 2018, as I look at it.
Thank you. We will take the next question from the line of Manish Oswal from Nirmal Bang. Please go ahead.
Yes, sir. Thank you for the opportunity. I have one question on the cost-to-income ratio. Currently, it is 47%, and what we have seen the larger banks now hitting especially the similar kind of loan book makes touching 40%. So, what is our overall medium-term outlook given the digital initiative across the business lines?
Yeah, I think we see our cost-to-income ratio steadily improving, but cost-to-income is a misnomer, and I'm hoping the income side continues to grow, but on the cost side, the cost to income does not give clarity because it's one single black box number on the cost side, where how much of the money is for the operating business and how much of the money is investing into the future. Therefore, we will not be carried away by the cost to income ratio as one black box. We will obviously want to significantly improve the productivity of our operating business and constantly improve cost per unit of business, which is obviously the key reason why you've seen. Keep in mind, when we acquired ING Vysya Bank cost to income ratio was 59%. So now on a combined basis, we are at 47%. Therefore, clear operating productivity improvements and including disruptive change, which is inevitable part of this digital journey, will continue to be our focus. At the same time, wherever we have conviction that we need to invest, we will not be colored by the cost to income ratio. but by the investment opportunity, including the front-end opportunity on the digital side. And Jaimin,
in fact, on the investment side itself, the very fact that we are paying 6% versus 3.5%, as Uday was pointing out earlier, that costs us 1,000 crores a year, that impacts cost to income, but that's also an investment.
Correct. Therefore, we would improve our income by 1,000 crores and our cost to income would have looked better.
Sure, sir. And second question on the fee income side, again, the fee income growth compared to peers group, slightly weaker side. So how do you see the growth in this line item going ahead?
If you look at the fee income, you'd have components of fees which come from third-party distribution, insurance, mutual funds and others, where we've had a steady flow. And if I look at what's happening on some of the other components, which are linked to businesses, again, we've had a good flow. So there are some spiky elements which happened last year, particularly during the demon period. You had some spiky elements where you had income, which are not there this year. And to that extent, on a year-on-year basis, we ended up with about 15% growth, which if I look at what is steady and growing, components like insurance, mutual fund, referral fees and others have shown decent growth as we speak here. And the rest of it will grow as we grow our business. Some of it linked to on the asset side, whether it is your loan processing fees, retail charges and whatnot, and others linked to areas like credit card growth and whatnot.
Thank you. We will take the next question from the line of Nilanjan Karfa from Jefferies. Please go ahead.
Hi there. Question, the first question that was asked, which is, how much we are paying on the savings account. Now, if we, let's say annualize the customer additions, it is about 4 odd million roughly, right? And so basically we are spending, let's say, 1,000 crores.
What customer additions?
The total customer to the bank. So I guess at the starting of the year, it was close to, I think, 9 million, right?
We were 8, we are now 12.
We are 8 as of end of March. We are around 8 as of end of March. We are around 12 as we talk.
Right. So basically, we are spending close to 2,500. I'm just doing, ballpark maths. That's how, most fintech companies would want to look at, what is the customer acquisition cost. There are 2,500. For fintech companies, they consider this number as way too high.
But how did you come to 2,500?
1,000.
Yeah, but you keep in mind that the customers we acquire don't start giving us immediate SAR. The customer acquisition today, the SAR growth happens over time. So there's a front-end cost.
And if you look at the SAR growth, including on increased basis, we've been able to grow SAR significantly higher than what the industry is doing. I mean, if I mentioned earlier about the fact that on this quarter average versus last year the same quarter average, our SAR is 60% higher. And if you look at industry number, they're somewhere in the mid-teens.
Therefore, the customer acquisition cost is front end. His or her balances grow over time.
Not just that. I think the other big mistake you're making really is look at SAR as replacement for term deposits. You're actually saving significantly. So from a 1,000 crore additional, you're only looking at the addition. You're not looking at the markdown, because when Jaimin is acquiring at 60% growth, which is, let's say, 25-30% higher than the marketplace, he's saving significantly on costs which he would have paid out as term deposit costs, really.
Deepak,
there is a significant saving on that front, really.
I think we probably need a longer discussion, because we have been spending, let's say, 1,000 crores for the last 4 years now, right?
Yeah, but we've been saving 5,000 crores every year also simultaneously, you see, because you're growing SAR significantly higher than what it would have grown had we not been offering this rate.
Sure.
Anyway, I think we should have a separate
there is a
discussion
stock
on
and
that.
perpetuity value. I think in your calculation, there is a stock and perpetuity value of the balance.
At what point, let me ask you, at what point do you think we will start, unlocking the value of this?
At this point of time, your term deposit rate is now close to 7%.
Okay, so
just to answer your question.
So my carry on the SAR, there is an ALM adjustment, it's still positive.
Yeah, and just to answer your question, you stop or slow down only when the differential between the normal growth rate and the growth rate at which you're running at is small. So let's say ordinarily if you had grown at 15%, if you start growing only at about that rate, that's the time when you cut down and you come back to the normal rate.
Sure. Okay. And second question, when it was brought upon, the LCR table has been brought upon, and if I look at the composition of that, it looks like the deposits which are going is essentially the non-operating deposits. So is it that the quantum of savings account that we are growing is essentially very stocky? It's not very granular.
No, it's very granular, because finally if you look at, we give you weighted average cost of SA also. Our weighted average cost of SA for this quarter is 5.58%.
That's correct. I'm talking about the nature of the savings account. Rate may not be...
As we have mentioned in our earlier that of course there are some institutional savings which are part of this, but a very significant portion of this is granular.
Thank you.
And with this institutional portion, our weighted average cost is 5.58.
Thank you. We will take the next question from the line of Prakash Kapadia from Anived Portfolio Managers. Please go ahead.
Thanks for taking my question. So if you could give us some sense on, rural India, some thoughts as we get into election year and the spate of state government elections. And secondly, on 811, given the profile of the customer, what products we are trying to focus, cross-sell and, ensure our advances grow with that base now?
Narayan?
Let me just give you a color on rural India. We had a good monsoon this year, and which is getting reflected in rural India, definitely showing good signs of growth. For example, our tractor finance portfolio has been growing well. As you all know, the tractor sales itself has gone up. Similarly, if you look at our commercial vehicle sales, it may not necessarily rural India, but good portion of it comes from rural India growth also. So definitely rural India is going signs of growth. One more example I can give you is that we have branches under the commercial bank which are in the towns, not in the tier 1 cities, but in the tier 2 towns and villages, where we see good growth in SA. In fact, the growth in SA has been higher than the normal growth which we have. So overall, if you ask me, the Bharat story is doing well for us.
Isn't it part, contradictory to the SME kind of piece, which somebody mentioned on the call, where, SME we are not seeing traction, because I guess, some of these tier 2, tier 3 would be SME or smaller kind of entrepreneurs or employees. So it should translate into higher SME growth, right? Or not necessary?
Not necessary, because SME is more urban, tier 2 urban, and rural is tractors and other things, and agri. And agri actually had a rough time last year. So actually it's coming back from a difficult period out.
Okay. Understood. And on the 811 on the product side?
I think product side, really the big thing is the cross-selling, which we are very focused on. And we think we will continue to acquire and get in more hooks for cross-selling. We are finding reasonable traction both in the digital and physical world. Shanti has got a wonderful phrase for this. She calls it the phygital world.
Yes.
And we are feeling good about it.
Yeah. We introduced credit card this quarter, which I announced.
Yeah, you mentioned in your remarks. So it'll be credit card, personal loans, those would be two key focus areas?
And more. Yes, we have physical debit cards, credit cards. We will be introducing few more products. The payment and the engagement on the transaction side itself is large. So across the range of products.
Understood. Thank you. All the best.
Thank you.
Thank you. We will take the next question from the line of Gurpreet Arora from Quest Investments. Please go ahead.
Yeah, hi. Thank you for this opportunity. 3 quick questions. One of the peer banks raised MCLR symbolically by 5 basis points just 2-3 days ago. So are we sooner than later in the rate hike cycle? That's one. B, I've seen the yield on advances have risen sequentially for us. So is it more to do with the CVC, personal loans, and credit card portfolio? And third data point which I request is, what percentage of our book would be on fixed rate and on MCLR? Thank you.
Okay, on the first one, I mean, just to inform you, on 31st January, that was the effect from 1st February, we had already raised our MCLR by 5 basis points.
Okay.
Okay, so that's on one. On second and third, I will ask Jamie to take it.
So actually, it's not correct that we actually dropped our yields, if you look both sequentially and year on year. And as we spoke earlier, yields have been dropping, and we've actually seen that trend continuing. Of course, this quarter the drop may be small, but it's still directionally negative.
Could be on fixed and MCLR basis?
Fixed would be roughly about 30% to one-third as a fixed portfolio.
Okay. And MCLR?
That's it. The balance will be floating.
Okay. Thank you. That's it. Thank you.
Thank you.
We have the next question from the line of Kisle Upadhyay from Ambit Capital. Please go ahead.
Hello, sir. Congratulations on a good quarter. Hello.
Yeah.
Hello, sir. Congratulations on a good quarter. My question is on SMEs. So we had seen two big disruptions in form of demon and GST, in which demon has already had 3 to 4 quarters and GST about 1-2 quarters, both of which impacted the unorganized and small businesses mostly. So any delinquency in the SME loan book or reduction in businesses from SMEs should have been observable now. So you had mentioned that you had seen some worry. Is there some reason for this worry in terms of numbers as well?
No, if you look at our last 3 or 4 quarters, a reasonable part of new flow has been from the SME segment, which has flown into the NPL on the basis of the slippages. The individual ticket sizes may not be large, but there has been some flow on that. And as we have been more conservative in the new risk underwriting, which we have been doing over the last 12 to 15 months, we feel that that has actually helped us contain what could have been more damage. And I stand by my original position that overall, I think in totality, the credit cycle, in terms of new flow for us, we are seeing a clear bottoming out, both in terms of the credit cycle on the stress side. That's what I mean. Not in terms of the loans, but on the stress side, we think we're now at the bottoming out of the new flow into stress.
You are talking about the SME loan book.
SME loan book also, we think of most of the things which would have surfaced has actually flown through. Therefore, the new flow now would be significantly slower than what we have seen over last 3 or 4 or 5 quarters. Or actually longer, 6 quarters post-ING merger.
Okay. So, sir, in your view, is the SME pain over and you would be looking to grow the SME loan book aggressively, or would you continue to be conservative going ahead?
We will watch the situation. We think the micro is getting better, but we also as we are going to see how GST settles down, as we get more confidence, we will start taking a call on these. And again, SME is a very general word. Within SME, there are different sectors, from a steel trader to a restaurant to a pharmacy or to a wedding contractor. So there are a whole range of SMEs. So maybe we need to go more segmental and continue with that as the basis for our lending and growth thereof.
Okay. So just one more question. So which segment in the SME would worry you the most, or have you seen the pain the most in the past 4 or 5 quarters?
I think the trader segment is something which we have been getting more cautious on.
Okay. Thank you, sir. Very useful.
Thank you very much. As there are no further questions, I would now like to hand the conference over to Mr. Uday Kotak for closing comments.
I know all you guys have to run to many other calls and you have got a very busy Friday evening, so I won't take more of your time. Thank you very much for spending the time and being on this call. And as we embark on 2018, so let me once again wish you a wonderful 2018, and let's hope that most of the year remains warm and does not get too hot. Thank you very much.
Thank you. Ladies and gentlemen, on behalf of Kotak Mahindra Bank, that concludes this conference call for today. Thank you for joining us, and you may now disconnect your lines.